Good morning. Today we are stripping everything back to basics. Before we get to the complex perks like company cars or share schemes, we must nail the absolute foundation of employment income, cash. You might think, if I get paid, I get taxed, it's simple. And in the real world, you'd be mostly right. But this is the ACCA Advanced Tax Exam. Nothing is ever just simple. The examining team loves to hide traps in the dates. If you get the tax year wrong for a £50,000 bonus, your entire income tax computation is wrong. Your personal allowance taper is wrong. Your tax bands are wrong. You lose 10 marks in a heartbeat. So, we are going to nail down the rules for salary versus bonuses right now. First, let's look at standard salary. There is a tension here between what the law says and what you must do in the exam. Strictly speaking, under tax law, employment income is taxed on a receipts basis. This means you are taxed when you actually get the money. If you do the work in March 2024 but don't get paid until May 2025, strictly that cash belongs to the later tax year. However, and this is a critical distinction in the ATX exam, you are rarely given a breakdown of monthly pay slips. Instead, the examiner gives you a company's accounting year and an annual salary figure. Because salary accrues day by day, the examiner expects you to use time apportionment. You must take the annual salary and slice it up to fit our tax year, which runs from the 6th of April to the 5th of April. Let's visualize a common exam scenario. Imagine a company called Cloud Corp with a year end of the 31st of December. The employee earns £48,000 in the year ending 2024 and £60,000 in the year ending 2025. The tax year cuts right across these two accounting periods. You cannot just pick one figure. You must build the tax year from scratch. You would take the income from April to December 2024, that is roughly 9 months of the £48,000 salary. Then, you take the income from January to April 2025, that is roughly 3 months of the new, higher salary. You add those two figures together to get your assessable income. And a pro tip for the exam hall, do not be afraid to count the months on your fingers. It is better to look silly for a moment than to guess gate months and lose the marks. Now, let's switch gears to bonuses. Bonuses are different. Salary flows evenly like water from a tap. The bonus is a bucket of water dumped on you all at once. It does not accrue day to day. Therefore, we cannot use time apportionment for bonuses. Instead, we use the strict receipts basis. But here is the trap: the definition of received is specific. Write this down. This is the golden rule. A bonus is treated as received on the earlier of two dates. 1. The date of payment, when the cash hits the bank. 2. The date of entitlement, when the employee has a legal right to be paid. Examiners love to give you a scenario where a bonus is voted on and entitled in March, inside the current tax year, but due to a bank error, it isn't paid until May, which is in the next tax year. They want you to tax it in May. Don't fall for it. The entitlement date in March is earlier. Therefore, it falls into the current tax year. If you miss this, you push income into the wrong year, and your whole tax computation collapses. So, the summary for this section is simple. For salary, you smooth it out using time apportionment. For bonuses, you spot the specific date, whichever comes first, payment or entitlement.